Hi, welcome to a short video on the statement of cash flows using the indirect method. Under the indirect method, net income is adjusted to its net cash flow from operating activities. Here is a comparative balance sheet that in a minute we will use to construct the statement of cash flows. Pay attention to this section. It is the difference from 2012 to 2013. The statement of cash flows organizes data into three categories: operating, investing, and financing. Cash flows from operating activities are cash inflows and outflows from daily operations of the company. Cash flows from investing activities show cash inflows and outflows related to the changes in the company's long-term assets, like equipment or machinery. Cash flows from financing activities involves cash inflows and outflows from changes in long-term liabilities and stockholders' equity. Issuing bonds or common stock and paying dividends are examples of this category. Here is a quick reference when dealing with current assets and current liabilities. An increase in current assets would be subtracted from operating activities, whereas an increase in current liabilities would be added. A decrease in current assets would be added to operating activities, whereas a decrease in current liabilities would be subtracted. This is a difficult area for some students. Think about it like this. An increase in current assets means you made a purchase, so cash decreases. An increase in current liabilities is added because we still have the cash. We start with net income from the income statement and add back non-cash expenses such as depreciation, amortization, or depletion. Here is your depreciation added to net income. If we had any, we would subtract gains and add losses for any property, plant, and equipment or investment sales. We subtract gains and add losses because they are already reflected in net income. We do not report a change in cash. A change in cash is the goal of the statement of cash flows. Therefore, it does not show up on the operating activity section. So we begin with accounts receivable. Here, accounts receivable is deducted since there was an increase from 2012 to 2013. We do not have the cash, but in essence, a piece of paper that somebody owes us money. We have a decrease in inventory. Lower inventory means more cash because we sold it. Accounts payable increased, and so did cash. In essence, we have yet to pay it, so we still have the cash. Accrued wages and interest payable decrease since we paid them with cash, which lowers our cash position. Income taxes payable increased because we owe more, we have yet to pay it, and still have the cash. Now let's go to the investing activity section. We purchased with cash more equipment, hence decreasing our cash position. However, long-term assets went down, so cash increased because we sold investments. Let's finish up with the financing activity section. We have a decrease in bonds payable, so cash decreased because we are paying off the bond. We increased cash under capital stock by $70. Paid in capital increased by $330, and we paid $200 in dividends, which lowers our cash position. The bold shown here is the change in cash for each section. We have a $350 increase in cash. One good way to think about this statement is that it takes the accrual accounting system back to the cash basis. The $350 is added to the $850, which is our beginning cash balance, to give us the $1,200 balance, which is our ending cash balance. This completes our statement of cash flows. The statement of cash flows also provides information about a company's ability to generate cash from operations its operating capability, its ability to meet financial commitments, and its ability to pay dividends.